just before we get started, how many of you think we're going to see a recession in the U.S. economy this year? Just by raise of hands. Okay, that's amazing. There's not one person here that thinks that there is going to be a recession this year. So this time last year, I asked the same question and was almost unanimous that we were going to be into a recession in 2023. So we should have been in a recession by now, according to many people, including many economists and strategists, and that was simply wrong. I was not in the recession camp, but I was definitely in the slowdown camp. And the reason is because the Fed raised interest rates 550 basis points in 18 months' time. And if you go back and look at history, the lag impact that has had, it would have slowed down the economy. The problem, or if you want to look at it glass half full, the benefits that we've seen in terms of the offsets of these higher interest rates is all the fiscal policies that have been put in place. We have put $9 trillion in fiscal policies and monetary policies in place since COVID. We just put in 2.5 trillion last year alone in infrastructure packages, 1.1 trillion in just pure infrastructure and onshoring. So we have more that is coming because we know that it takes 3 to 4 years, 3 to 4 years to get this stimulus into the economy. It doesn't happen overnight. And let me give you just a stat that I just find incredible. If you go back to May of 2020, when the country was closed down, the fiscal and monetary policies that were put in place was equal to 60% of US GDP. If you go back to the last crisis that we had, which was in 2008, it was the Great Financial Crisis. And by the way, it was a real great financial crisis. It was not Silicon Valley Bank failure. It was Lehman and Bear Stearns, and even Merrill Lynch was on the ropes. So we had really big bank failures and big bank problems in 2008. And if you add the fiscal and monetary policies back then, it was 5% of US GDP. So I just mentioned that we put in 60% of stimulus. So all that money is sloshing around. And by the way, we needed to do that. We closed the country. The world closed. So people ask me all the time, how do I rank or rate the Fed? I give them an A+++ back in May of 2020 for acting quickly and putting a ton of money in because clearly they saw something very troubling in the bond market and they acted very swiftly and appropriately, in my opinion. Now, we can talk about fast forward a few years and the transitory situation and the fact that we continue to pile money, increasing our debts. That's problematic. So I give a D to the Fed for holding on too long for the interest rate policies that they put in place. And we can get into the Fed and all of that. But let's just go back to the economy for a minute. So I look at the pieces of the US economy, and 70% of our economy is the consumer. So we root for the consumer. And the consumer is actually doing better than expected. TV wouldn't have you believe that because they like to sell negativity, but the consumer is doing pretty well. In fact, Bank of America just this morning, they released monthly credit card data because they have so many clients and customers, and consumption is growing at around 3.2% in this past month. Now, the consumer is doing better than expected because the job market has been very strong. I look at a lot of different economic data with regards to employment. And you guys certainly, and gals, don't have to get into the minutia like I do. But one of the things that I look at, while the job numbers every month get the real top billing in terms of TV, it's so important, it's backward looking. What's forward looking is weekly jobless initial claims. Now, you really don't have to get into weekly data. That's crazy for you. But for me, what I try to do is I look at it on a 3-6 month basis to smooth it out. And if you do that, you're running at about 215,000 weekly jobless claims on average. And you say, well, is that good? Is that bad? So historically, during recessionary times, that number gets to 375,000 weekly jobless claims. So we're nowhere near a recession on the job front. You can look at ADP. You could look at Challenger Gray layoffs are down 4.6% year to date. You can look at JOLTS, job openings. That's what I also look at. We have 1.3 jobs available for every one unemployed person. That's pretty good. So we have a very tight labor market. I'm excited about it. It's also my number one worry. It's the number one thing I watch every report I can get. Because if that starts to change on the margin, that's what worries me. Now, for now, we don't have to worry. As I just said, the numbers are really great. We have better jobs. You have decent wages. Wages are growing at around 4.5%. If you switch a job, you can get 10%. So if you want a job, you can get a job. If you want a job, you're getting actually better than average. Historical average is about 2% for wage growth. So those two things are really pretty good. Home prices are higher. Consumers feel better about that. Equity prices are higher. And we have $9 trillion in money markets, according to BlackRock. Larry Fink, I kind of trust him. He kind of knows what he's doing. But $9.1 trillion in money market funds, getting about 5%. Sure makes sense to me. You can sleep at night in terms of having a diversified portfolio. But that money is on the sidelines, and that's a nice tailwind for equity markets should that money come into equity markets. And I don't think it's all going to come in. But my point being is the consumer feels good because in cash they get 5%, and maybe in the market you get double digits. And as I just mentioned, all of these other measures and metrics are certainly nice positives for the consumer. Where is the consumer spending? On services. We've been hearing that for a long time. I think there were more people here today than last year, right? Am I right? And I don't know that, but I'm just looking. This is services, right? This is where people want to get out and about and travel and go to restaurants and hotels and all kinds of things. Now, is it going to stay at the torrid pace that we've been seeing for the last 3 years? No way. I think it is going to start to slow, but off of a very high base. I also think the goods disinflation is starting to play itself out as well in terms of the negativity. I think you're going to start to see a little bit higher goods inflation. And so we're seeing a nice, healthy mix within the consumer. And we know that services is 75% of consumption. So we root for consumer and we root for services. So that's why I'm bullish there. And that's why the economy is doing what it's doing. And in terms of the second piece that I think is really powerful, maybe underappreciated, is the manufacturing part of the economy. We are seeing pockets of a mini renaissance in manufacturing. Manufacturing is 10% of the US GDP, but there's a multiplier effect. For every one person that's employed in the manufacturing industry, 7 other jobs are created around it. That's why the politicians actually don't mind. They agree on something on both sides, right? Because they're all about jobs. So we're having this mini renaissance in a couple of different areas. Has to do with supply chains coming here to the States and around the world other than China. So companies got burned during COVID because a lot of their supply chains were in China, and China was opening and closing and opening and closing, and there was no visibility, and that really led to a lot of the inflationary pressures for sure. And I don't fault US companies for doing that because we told them to do that as investors. because that's where it was lower cost for them to do it. So now you have a massive change that's happening. And I think it's like more than a decade theme, like way more than a decade theme. And I'm like totally exposed in my equity portfolio for sure, because I think you want to be there in some way. But supply chains are coming over. Onshoring, reshoring is definitely a very powerful theme, and it doesn't happen overnight. I mean, just because you say you're going to build a manufacturing plant here, I mean, it takes 2-3 years. And then think about it. Not only does it take that long, but you have to employ more people. The material costs that you have to put in place, that impacts that sector. The transportation companies have to bring all the materials to these places, so that too is a multiplier effect. Anything tied to clean, green, power, and grid are all parts of this theme. We are going to spend between now and 2050 $4 trillion on all of that stuff that I just mentioned. That's why I think it's so powerful. And I think it's just getting going, and it's sort of interesting. So like we just had earnings season for the S&P 500 companies, and I listened to a lot of different conference calls, and I learned a ton. I own this company called Quanta Services, and they are all about the grid. And the CEO on the call said that data center requirements are going to be unbelievably strong, much stronger than expected in terms of using power. And Eaton Corp said the same thing. And Dominion, a utility company, said the same thing. People were thinking CapEx budgets for the utilities were going to fall. They can't. And that's what these companies are all saying. So CapEx is going to remain elevated because, by the way, we have not even we've just been kind of like maintaining the grid. We haven't actually done what is necessary to power data center, to power this whole AI issue and theme and EVs. There's so many themes around all of this stuff. And so that's why I think it is really very, very important for our economy, and it's working. I mean, all the companies I just mentioned, and then some. Book-to-bills are well north of 1. Orders are actually just starting to inflect. And most of these companies have said what I said earlier, that the $2.5 trillion that was put in place last year in terms of passage of all these new infrastructure programs, they haven't even seen a lot of the demand yet from that. So this is a big one. Again, I mentioned it's only a small piece. Manufacturing as a whole is only 10% of the economy, but this one is going to impact a lot of people and a lot of things, and probably to some degree keeping inflation a little bit elevated as a result. The other part of manufacturing, because there's really two areas that I'm excited about, and that would be aviation. I'm not saying go out and buy an airplane, because I wouldn't, an airplane stock. But I think of, while Boeing has their problems, yes, they do, we know that, they will get through it. They have a duopoly with Airbus. Both of them have 13,000 planes in their backlog. Boeing itself has $500 billion of backlog, 9 years worth of planes in their backlog. It is not a demand problem at Boeing. It's obviously a safety one. It's an interesting dilemma that they're in, but they're fixing it. And just think about all the companies that are suppliers to both of these big, enormous companies. I mean, there's one even here in your hometown, in Spirit. But there are companies that make engines for the airplanes, like General Electric, like Raytheon. You have a lot of various different subcomponents in this industry. And so I think those two pieces are really very exciting for me within this piece of the economy. So you add it all up, and I come back to, we didn't have a recession last year. And in fact, we had 3.4% GDP growth. We grew 2% in the first quarter. We grew 2.1% in the second quarter. We grew 4.9% in the third quarter. In my 33 years of doing this, I've never seen 4.9% growth. That's enormous. And then we grew 3.2% in the fourth quarter. So we saw really, really healthy growth. And by the way, I track, it's very wonky, the Atlanta Fed GDP tracker. Basically, all it is every data point, economic data point that comes out, it goes into this computer and it spits out real-time growth for the economy. So there's no opinion. That's actually why I like it. It just throws a number out. And the number for the second quarter, it just came out yesterday, comes out regularly. For the second quarter, we're tracking 4.2% growth. I mean, we just reported 1.6% in the first quarter, which I think was bogus, by the way. I think that's going to get revised higher because they had a lot of consumption data that I think was misrepresented. So we're probably not growing 4.2. But are we growing 1.6, which is what we just saw? I don't think so. And my point being, all of the stuff that I just talked about and all the stimulus is leading to better growth. And maybe we grow to 2.5% this year. Why do we even care? Why are we spending so much time on what's going on with the economy? Because it directly impacts earnings. And that's what I care about. And that's what the equity markets care about. My good friend Larry Kudlow, 18 years ago, told me stocks follow profits on the way up and on the way down. And we're on the way up. We're going to grow, in my opinion, 8 to 10% in earnings growth this year. And we just grew in the first quarter 7.1. And if you exclude Bristol Myers, which had a $12 billion charge, you actually had 10.1% earnings growth. Well, how about that? Most people were thinking it would be 5. So numbers are getting revised higher, hence higher stock prices. Now, last year we were up 26%. That's not normal. By the way, 2 years ago we were down 18%. That's not normal. Year to date, we're up about 8 to 10%, depending on the indices that you look at. That's about average. Long-term total return for the S&P 500, I'll give you an exact number, it's 7.7%. That's pretty good. So people got really down 2 years ago. They were really up last year. But last year was also very misleading because 90% of the returns were driven by the Magnificent Seven technology stocks. You know them. NVIDIA, Amazon, Alphabet, Meta, Netflix. You know them. What's sort of interesting to me is since October, you've actually seen a broadening out in the market to technology is doing okay, but you're also seeing other sectors participate, like energy, like financials, like industrials, which I just mentioned, and materials, some discretionary. That's healthy. And the reason why we're seeing a broadening out, it goes right back to what I was just talking about in terms of earnings. Earnings were actually pretty good in these sectors, and yet they were left for dead last year. Everybody just wanted tech. They just wanted communication services. They wanted nothing to do with any of these other sectors. And when these companies started to deliver on earnings, people woke up. And they said, wow, but the earnings are good and the stocks are really cheap. And they're a bit contrarian, which is typically how you make a little money in the equity markets anyway. So I think it's much healthier. What's also happening is you're seeing a little bit more of a narrowing within growth versus value. And that's kind of intuitive just because technology is growth and they did so well last year and all these other sectors are value and they're now catching up. And so I think that is a really pretty big deal. And what we're seeing on the earnings front is not just top line growth. Like if you get like a 2.5% GDP number for the economy, That's about equivalent to about 5-6% on the top line in terms of revenue, sales. What I think is underappreciated is the margin side of the equation. It's really powerful. In fact, I get more excited when I see a company that can deliver on margins and see an increase in margins. Because if you get the top line growing at 5-6% and you get some margin expansion, you get a nice operating leverage to the bottom line. That's really pretty powerful. Why are margins doing better? U.S. companies are amazing at restructuring, at cutting costs, at being lean, at improving productivity. And at any early signs of a slowdown, they will lay off. That's why I go back to, I watch the labor market very carefully. And they also have pricing power. And it's amazing, some of the pricing power that we have seen. Pepsi grew prices last year in the first quarter, 16%. And that to me is incredible. I like potato chip, but that seems a bit egregious. Fast forward to this past quarter, and they grew prices, but just by 5%. Well, we still are paying a lot higher prices, unfortunately, so it still hurts. But they have the pricing power on top of the pricing power, which is incredible to me. So their margins expanded 300 basis points in the quarter, which was crazy. So I think that it's the combination of growth on the sales front and on the margin front that will lead us back to that 8 to 10% number that I was talking about. So just to hit on inflation, because that's obviously on everyone's mind, talking about pricing power, we've made progress. We peaked in the CPI in one of the inflation metrics, and there are a dozen of metrics to look at, but we peaked at 9.1% 2 years ago in inflation, 9.1%. Fast forward, we're now at about 3. The Fed wants to get us to 2. I'm not sure we get there. And a lot of it is because we are growing faster than expected, faster than trend. Trend growth is 1.5%. And what are the numbers we just met? We just put up a 3+ number last year. We're headed for maybe a 2.5 this year. Naturally, you're going to see inflation be a bit higher. And not only that, what people are not talking about is the global economies are starting to do better. You may not believe China's numbers. I'm suspicious myself. But they just put up a 5.5% GDP number. What I don't know if I believe the actual number, but I see the stimulus that they're putting into their economy, and they desperately need to. But they just grew second quarter in a row, 5+. They're running at a 6% sequential annualized growth rate, 6.6%. We have India. India's going to grow 7% this year, and no one's even talking about it. It's like one of my favorite areas to invest, in addition to all the infrastructure onshoring things too. We can talk about themes in a bit. So you have 7% in India. You have low single digits in Japan, maybe 1%, 2%. But they are seeing a benefit from a lot of companies leaving China to go to Japan. And they have also, their demographics are changing as well. So they're starting, it's one of the best equity markets in the past 12 months. Is Japan, which is interesting. It's interesting also because there's this really amazing investor you might have heard of, Warren Buffett. He's actually been buying, and has been for the last 2 years, he's been buying Japanese companies. So sort of interesting. But globally, we're seeing better growth. The Eurozone, I think, is spotty, but I think they still remain pretty accommodative, and they're talking much more in terms of accommodation on monetary policies and even fiscal policies. So you're seeing better growth around the world in addition to better growth here. And that, I think, is going to lead to inflation being sticky and stubborn at that last mile, going from 3% to 2%. I hope I'm wrong. Either that, or I hope the Fed wakes up and says, we don't need to get to 2. We should start easing at 2.5, which they probably should. But they're in kind of this conundrum because no matter what they do, they're dealing with all this other stimulus on the fiscal side. So we started the year, people thought that they were going to cut interest rates, the Fed, by 6 times. I never thought that. I was kind of in the 3 camp. The data has come out, and I don't think they're going to do it at all this year. I don't think they have to. If we can stay elevated in growth, and again, around the world as well. But their commentary certainly is interesting. It sounds like they want to, and that they're data dependent. And maybe we get a really good inflation number next week. We get another CPI report next week, and maybe it's great. Maybe it does get to 2. Well, then I'll be shocked, and I'll be wrong, and that's okay, because that's an area where I would not mind being wrong, because that's a positive. So to me, we have to watch the Fed. I can't wait until maybe it's this time next year, Margaret, that I don't have to talk about the Fed and I don't have to answer questions, because it's really annoying. Because there's just so many moving parts. And what I would say is, if I were head of the Fed, which I would never want to be or could be, but I mean, they have so many speakers that talk every single day that lead to the confusion. They're not helping anybody. And they're wrong half the time. Look, I'm wrong half the time. But I mean, they're publicly, they go out there and they kind of dig in their heels. And the economy is very dynamic. There's so many moving parts. So I hope that's the case, but we'll see. We have to deal with the Fed, and that's what we have to deal with. I just think at this point, fundamentals matter more, and fundamentals are pretty good. Now, not everything is perfect, because I always get, well, what do you worry about? You sound so optimistic. I worry. Trust me. In fact, I worry when I don't worry, because that means I'm complacent. So I worry about geopolitical issues, which I have no edge on at all. I'm more inclined, though, to kind of put my blinders on from an investment point of view on any big news announcements which causes our markets to fall. I have this old saying that, and you've heard it before from not just me, you buy low and sell high. Most people do not do that. They buy high and sell low. But if you get a bad headline from the geopolitical situation, which I'm sure we will, that's when you look for big blue chip companies with awesome free cash flow, great market shares, great management teams, etc. Good valuations. If you can get something like a McDonald's down 20% because of a headline from the geopolitical side of things, that to me is something interesting. They have nothing to do with anything geopolitical. So that's the point being. As an investor, I try to look for those sorts of opportunities. In terms of some themes, well, let me just get through the rest of the worries, because there are quite a few. So geopolitical, it's the Fed getting it wrong. I do worry about the labor market. There's no reason at all to worry about the labor market, but it is something that's on my mind. I get the question on debt and the levels of debt in our country, which is horrible. And I don't know if we're going to have a resolution in my lifetime. I think it's going to have to be pushed out to my 17-year-old and that generation, unfortunately, because we kick the can all the time on the government side of things. We can barely get a continuing resolution passed without all fanfare. So I can't imagine that we're going to address the debt. We're going to have to. Does that mean higher taxes? Warren Buffett certainly suggested so last weekend at his annual meeting. But we'll have to see. I think a lot of the reason gold has gone up a lot this year is for this very reason, because people are not only geopolitical and inflation, but also this is a burning question. The problem is, if it's Biden or Trump in the office, they are both spenders. in different ways. So I'm not going to get into a political discussion. You just heard from one of the experts. But my point being is, if either of them are in there, you're going to continue to see spending in general, and our debts are going to go up quite a bit. So that's something that bothers me. I don't know if it really changes the way I invest, but it's certainly something that will cause volatility along the way. In terms of, I don't really worry about the elections, so to speak. I mean, someone asked the question, is gridlock good for the markets? Gridlock's great for the markets. We love gridlock because nothing gets done. And while that's sad to say, we equity people and fixed income people, we don't want surprises. And so no matter who's in office, it's really going to be the composition of Congress that's the most important. And it looks like right now, I mean, a lot can change, but it looks like right now you will have a split Congress, and that I think the markets would applaud. I will say this, depending on who is in the office of president, sectors will change for sure, but I think the overall market will be satisfied with it. But we shall see. So some themes. I just want to see time. Am I all right on time? Okay. So just a couple of themes that I like. I am a very big thematic investor. So I think a lot about the macro and the economy, but I also then think about kind of what are some of the powerful things out there that I see, and then I try to find companies that will participate. So we mentioned a big one in terms of onshoring, reshoring, and aviation. That by far is the one I'm most excited about because it's by far the broadest. I mean, I hear from a lot of different sectors, a lot of different companies that are going to benefit from that. So just that's something that I think is big. One that will not surprise you, but I think also has a very big total addressable market for the next decade and many decades to come is cybersecurity. When we have cybersecurity companies having cyber attacks on themselves, we have a problem. We have a big problem. McKinsey estimates it's going to be $1 trillion total addressable market by 2030. Who knows? But I think it's bigger. And I think it's just as important as AI. We can certainly talk about AI if you like, but you've probably been AI'd out by this point. But cybersecurity is interesting to me because I talk to chief technology officers at a variety of different companies, and I ask them, what are they spending on? And they are spending on AI because they are trying to learn that. They have no idea what it is and how they can implement it. But this number two is on cybersecurity. Management teams are nervous, really nervous, that one day they wake up and then their whole company is blown up. Look at United Healthcare, over $1 billion hit overnight. So I think the big problem, what's happening is you have so many vendors out there, and CTOs will tell you, I want to use a few vendors. I want to have diversification. The problem is all of these companies don't talk to each other, so nothing really works. So what I think is going to happen over the next decade or two, I think you're going to see the big 5 players, maybe it's 7, maybe it's 10, but no more than that. I think they're going to get bigger. I think you're going to see massive consolidation in this industry. You already are starting to see it. And then therefore, you'll have better technology and you'll have better communication between vendors, fewer of them. And so I think that's a really powerful theme. On any given year, the stocks go up and down. They're super volatile and they're not cheap. You can just own the cybersecurity ETF hack and just call it a day. You'll have enough diversification and less volatility for sure. But it is something that is not going away, unfortunately. And that's kind of an understatement. Another theme that I like, that's probably not that popular right now, but I do think it is also a decade-long theme, even if it has some struggles this year because of interest rates, is housing. We are 5 million homes short in this country. If you talk to any of the home builders, they will tell you that they have underproduced homes for the last 14 years. They are much more regimented than they ever have been, for good reason. I mean, it's been a boom, bust, and that sort of thing. We have 5 million millennials that are just about to buy their first home. In fact, I actually own this company, D.R. Horton. Maybe you've heard of it. It's a home builder. They had, now I know this is seasonally a good time for home builders, the springtime, but they weren't the only one to post 55% order growth sequentially. And they have about 65% of their mix is first-time buyers, and that grew 24% year over year. So I'm looking for the first-time buyer theme. And I'll tell you, the other thing that a lot of the home builders have said is it's actually cheaper to buy back their stock than to actually buy land, which I think is also sort of interesting too. And so I think that this is going to be something that is with us. Interest rates are going to certainly create volatility on any given day. But I think the reason housing is so important is because I kind of keep coming back to this multiplier effect. When you buy a home, you have to fill it with stuff, right? You have to buy stuff outside the home. You have to buy a car or a truck to get from the home to where you're going. In fact, there's a huge correlation between auto sales and home sales. And we know that auto sales that are running at about a 16 million seasonally adjusted annualized rate, pretty healthy. So housing is a really big part of our economy, but it's also, I think, a really powerful theme. Now, I know you're going to tell me that, well, I have a 2% mortgage, 30-year mortgage, and I refinanced all the way down, and 80% of the homeowners, existing homeowners, have a mortgage under 3%. So they're not leaving for a 7% mortgage. So that's one of the reasons why I will say I think this year you're going to have a transition. I think new home sales will be stronger. Existing home sales will remain muted. But if interest rates do eventually come down, which I think they will, even if they stay high for longer or higher for longer, they will come down. And I suspect many of you in this audience have had a mortgage rate at one point in your lives, maybe in the double digits. And you survived, and the economy survived. So I'm not saying we're going to double digits. And I would say that if we stayed at a 10-year, it's probably like an 8% 30-year fix, that will slow things down. There's no question. By the way, that's what the Fed wanted. They wanted to slow the cyclical interest rate sensitive sectors. And by the way, last year was not great for the data that was presented to us in terms of the existing home sales, new home sales, that the government pending permits, all that. It was garbage. But if you look at the stocks, some of those stocks, the home builders themselves were up 40, 50, 60% last year because the market anticipates 12 months ahead of time. So they were anticipating things getting better. I will tell you, the home improvement companies have done nothing. Nothing. Because they were actually beneficiaries of COVID when we're all buying stuff left and right to fill the homes because we were in the homes 24/7. But how many TVs do you need? How many dishwashers? You know, how many times do you want to paint your room? Well, I like to paint my room a couple of times a year. I like the color change, but they were huge. They had comps, same store sales, that were double digits throughout COVID. So naturally, as you reopen the economy, they're going to go through some struggles. And they have, but that's where I see opportunity. Another theme I like a lot is energy. And Energy has been interesting to see what the sector last year did not do very well. In fact, it lagged pretty dramatically. But it's interesting to see the energy companies and what they're doing with their money. They see value. In the past 12 months, energy companies have actually done $500 billion worth of M&A. And why I think that's interesting is they basically see value when the public markets could not see value and they wouldn't pay. And I mentioned the great Warren Buffett. He buys Occidental every single day. Any day he can, he continues to buy and buy and buy. And what's happened is I think the companies have gotten religion. It started with ESG about 5 years ago, and I think it's evolved since. But the companies have gotten religion in terms of overproducing when prices are high. They're still producing, but they're taking that cash flow and they're sending it to shareholders. And that's actually very positive. And that's what shareholders wanted. And so what I do think is interesting is the two biggest players in the United States have made big, big acquisitions after doing nothing over the last 10 years. Exxon buying Pioneer, Chevron going on a buying spree, 4 different companies in 2 years' time, 2.5 years' time. They want to get energy independence, energy security, and they're doing it in spades because they have the free cash flow. Because guess what? They mint money. Their cash break even is $35 barrel of oil. It is at 80. So can you imagine the free cash flow that's coming in? Well, thank you very much. It's a pleasure to be back. I hope you have a great rest of the day.